This accounting mini lecture examines closing entries. Our closing entries accomplish two things. First, they're going to zero out our temporary accounts, which are revenue, expense, and withdrawal accounts, to ensure that they are zero by the end of the period so that we are ready to start our new accounting period with a zero balance, and we can then begin accumulating amounts in those accounts again. The second function of the closing entries is to ensure that our net income and our withdrawals are properly closed to our equity or capital accounts. Remember, our temporary accounts are revenues, expenses, withdrawals, and the income summary. The income summary is a temporary account created solely for the purpose of making our closing entries, and we'll learn more about it in just a moment. Our permanent accounts are our balance sheet accounts. This includes assets, liabilities, and owner's capital or stockholders' equity for a corporation. We are going to have four basic closing entries. The first closing entry, we are going to close our revenue accounts to the income summary. Next, we'll close our expense accounts to the income summary. Our third entry will be to close the income summary to the owner's capital. And finally, we will close withdrawals to owner's capital. All right. Here we have an adjusted trial balance, and we can see our revenue line items are highlighted. Now you'll notice that revenues carry a credit balance. In order to zero out a credit balance, we will need to debit those accounts. In this entry, you'll see that we debit those two revenue accounts based on the balance they are currently carrying. The total credit goes to the income summary. Here we can see how this impacts each of those T accounts. For consulting revenue, we have debited the account for the total credit balance. Therefore, it now has a zero balance. The same is true for rental revenues. That total credit is now placed into the income summary account. We'll follow a similar approach for our expenses. We'll note here that expenses carry a debit balance. Therefore, in order to close our expense accounts, zero them out, we will need to record a credit. In this entry, we record a credit to each of our expense accounts based on their current balance. The total debit goes to the income summary. On this slide, we see the T account impact of this entry. We can see that for each expense account, it now has a zero balance because we have closed the account and zeroed out the balance. In the income summary account, on the debit side, we see the total expenses that we've closed. On the credit side, we see the total revenues that we've closed. The difference between the two is the net income. Next, we are going to close that income summary balance to owner's capital. We will debit the income summary for the total balance, and we will credit owner's capital. Here we see the impact. The income summary account has now been zeroed out. That credit now goes to the owner's capital account, so we can see that the net income has actually increased the owner's capital balance. Finally, we're going to close the withdrawal account. You'll notice the withdrawal account carries a debit balance. Therefore, in order to close it, we need to make a credit entry. Therefore, we're going to debit capital for $200 and credit owner withdrawals for $200, as the withdrawals do reduce the balance of the capital account, and here we see the effect of that entry. It has reduced the total balance of our capital account. So now let's look at a post-closing trial balance. Our post-closing trial balance will only include our permanent accounts. Remember, we've closed revenue, expenses, and withdrawals. Therefore, those accounts no longer appear on the post-closing trial balance. The post-closing trial balance only includes the balance sheet accounts. Thank you very much for watching this video on closing entries.